What should our viewers know about taxes that they won't learn from your typical CPA?
Well, I think the biggest problem that I've seen over the years, or at least since I've worked in the private sector, is the fact that there's not a whole lot of communication that goes on between clients and CPAs, and unfortunately that leads to a bad result many times. Most CPAs, most CPA firms, while they may be quite competent, kind of have a factory mentality on how they deal with clients and tax returns. Their mission is to basically get your tax returns done as quickly as possible, so pretty much you quit calling the office and asking, are my tax returns done? And so I think during the rush of tax season many times that many firms are more concerned with getting the returns done than actually getting them done correctly. And so I guess what I'm trying to say maybe is that you kind of have to have a looking forward approach versus a looking back approach. You know, when you get your tax returns done, sometimes it's a little too late to do something for that year, but certainly that should be the impetus to try and do some planning and do some strategizing so you can improve things for the next year.
Jack, can you give me a couple of examples of recoveries you've made from your clients by finding errors and omissions?
Well, let me just say that it's part of when we get new clients, what we'll routinely do is we will be following up other CPAs who've already done clients' tax work. And again, many times, I'm not saying every time, but many times, if we find errors in what I would consider to be strategy, meaning that their structure wasn't set up correctly in order to have them pay the least amount of taxes, and many times we find out-and-out errors on tax returns. In my opinion, stuff that shouldn't happen, but happens on all too frequently basis.
Right. Do you have another example of something like that?
Oh, sure. In fact, Dr. Brown had referred a client over to me. It was a California client that happened to be under audit by Internal Revenue Service. And of course, as I mentioned earlier, we do a lot of representation work, and we agreed to represent this client, and he had a fairly decent sized company. And in looking over the client's prior year tax returns, we basically found some what I would consider to be gross errors on the returns. And as it turns out, we actually got this client back about $73,000 in tax, and that was before the audit even started.
So is it smart to trust a CPA to find all the deductions and credits, or does the taxpayer need to be more involved?
Well, I think that the more involved that the client is, I think, ends up with a better result. Because a lot of times things happen that clients don't think anything of. They don't think that there's any tax significance. And as it turns out, from talking with them, it does. I mean, we've had many clients that had lost money in real estate, lost money in other investments. They had invested in other companies that basically just didn't think twice about it and just figured that the money's gone, never realizing that there was a huge tax impact to having lost money.
Right. Well, a question we hear a lot is that many people are interested in creating small businesses or LLCs for side businesses, hobbies, etc. Can you legally turn your side business into a tax haven? Is it possible?
Well, first of all, let's start back a little bit. I think that anybody that's going to be in business today, whether it's a side business or your major business, should really be set up as a corporation. People smarter than me a long time ago have thought about this. You know, years ago, people incorporated not because they thought that they were going to get sued, but they thought, what happens if I go bankrupt? And you don't want to lose your personal assets. So people incorporate for two major reasons. One, they want to basically set up kind of a wall between their business activities and their personal assets, so in the event things go bad, they don't lose their house. And the other stone cold fact is the fact that corporations get a better deal on taxes. And again, that's not something I invented. That's just the truth. But why should someone want to start a side business and be a corporation? Well, again, a couple reasons. One, for liability reasons. Number two, for tax reasons. And as it turns out, corporations actually can get more deductions than you can as an individual person. There's another great reason for incorporating your side business. Statistically, the IRS audits far less business returns than they do personal returns. And so every year the Internal Revenue Service does a study on how many or the types of returns that they audit. And as it turns out, that when people file partnership returns, subchapter S corporate returns, and C corporate returns, the audit selection rate is about 0.5%, as opposed to your individual 1040, which could be as high as 5 to 6%.
Right. Now, another one, and I know the folks watching are going to love this. Can you turn your active investing into a business, and is there any tax advantage?
Can you turn your active investing? Well, certainly if you want to consider yourself a full-time trader, day trader, think about it. There are so many tax advantages to be considered a full-time trader over a regular investor, and of course that's the major reason why people want to do that. An easy example is if you were just a normal investor and you lost money in the stock market, for tax purposes, your losses are limited to $3,000 a year. So if you happen to have a really bad year and you lost $100,000 and nothing else happened, you'd have to go 33 years before you're able to use up all the losses. Well, if you could be treated as a full-time trader, you get to write off the $100,000 loss at one time. And that's just one of the many advantages that you can get by considering yourself to be a full-time trader.
You can take the whole amount because you set it up as a business.
Correct. You set up a corporate entity and you treat yourself as a full-time trader. That's exactly right, Steve.
Give us a couple examples of recoveries that you've made for clients by finding, as a result of errors or omissions that you've found.
Well, like I said, I mentioned the one earlier I had mentioned where the company was under audit. Basically, the accountant, a California accountant, didn't understand net operating losses in California. They didn't understand alternative minimum tax. And here's what happens. And I understand, but I don't understand. Tax software is great software, except that it's still a garbage in, garbage out system. And so no matter how you input the data, when you're done the tax return, you have to be able to step back and look at the return and know, does the return look correct or not? And in that earlier example, the alternative minimum tax was off by a significant amount of money. The net operating losses in California were off. And so the tax software said the return was done correctly, but of course it wasn't. Another great example, and most commercial tax softwares get this wrong all the time. People who have investment property that sell it. Tax software will routinely miscalculate how gains on the sale of real estate is calculated. And the software would have you believe that it's done correctly. But the truth is it's done incorrectly.
Jack, thank you so much for being with us. Is there anything else you'd like to add before you go?
I guess my poster child case is we had one client that owed the Internal Revenue Service $1.4 million for many, many years. And we actually settled with the IRS for $16,000. And he didn't even have to pay the $16,000 at once. How do you like that? He was allowed to pay it out over 2 years. And so I just think that most CPAs, as smart as they might be, just don't have that in-depth experience of having worked for the IRS. And I think that kind of puts the clients on a level playing field with the Internal Revenue Service, something that they could not have had before.